Let's spend 10 minutes just going through some questions. If we can get a mic runner. Now, the deal is the questions have to relate to the previous topic. If it's going to be something about that, I haven't covered a lot of things yet in finance, so I'm about to cover a lot of different things. So if it's something I'm going to cover, I'm just going to tell you, look, I haven't covered that yet. But if it's relating to previous topics, definitely I can go into as much detail as possible. So who's got a question about something previously mentioned? We'll start at the front of the room and we'll just keep going back. So if you can just... Front of the room, anyone? Yep.
With the criteria for getting a loan on your equity from your own house,
yes.
Are the same criteria against an investment house the same, or are they a bit more laissez-faire about
yes
that?
And no. I haven't covered it because you got rental to add to your serviceability when they work out the DSR ratios. About to cover that in about 15 minutes. So definitely. The answer is no, it's different. It's different. Any questions on this side, just in mid of the room? No? Anyone else at the front of the room here? Okay, that lady over there just in the white.
My name's Chris. You touched on it briefly with vendor finance for deposit on a property. How do
Yes.
the banks treat that in your finance application, or are you going to cover that?
Tomorrow. I'm going to cover tomorrow 6 ways to buy property with no money. And vendor finance is one of the ways that it's the easiest way to buy property with no money. And the other way is a combination of personal loan and a mortgage. Okay, and I'm going to show you how the banks treat the application and how the DSR ratios work on that. So that's definitely going to be covered tomorrow. Yes. Any questions towards the back of the room?
Can I ask how many properties you own?
How many properties I own? 17 with about $10 million. But at the moment, I just buy land component property, so I'll go through that as well. So when I started off, my first property was in St Kilda. It was a one-bedroom with no car park. Everyone told me I was an idiot for buying it. It had rising damp, all this kind of stuff. Bought it for about 90 grand in the late 90s. It's worth about 450 now. But because I don't pay any tax anymore, what I do now is I buy established property as close as I can to the city with the largest land component. So I buy 30-acre blocks, 1,300 to 1,400 square metre blocks for subdivision purposes. But I'll cover that tomorrow when I go through building your property portfolio. It's a very good question, actually, because at different stages of your property acquisition, you should be buying different properties. So when you start off, you should be buying properties. Basically, your first 3 purchases should be done in a way that they get rid of all your tax. So your first 3 properties that you purchase, doesn't matter if it's apartments, townhouses or house and land, you should be gearing towards getting rid of all your tax. Then after you have no more tax benefits, you should only be focusing on property that has the largest land component as close as you can get to the city that's affordable for you based on your serviceability. So there's actually different properties you should be targeting at different phases of your accumulation process, because your goal as an investor is to control as much assets as you can. Would you agree with that? That's all you just want to... If you can secure 10 million in 3 years, then definitely do it, because in 20 years' time, that 10 will go to 20, and then you've got a lot of options. Would you agree? So the key is, and this is what I'm going to spend tomorrow on, which properties you should be buying and why, that will allow you to buy more property quicker and risk manage as well. So that's the key with building a large property portfolio. So tomorrow I'm virtually going to spend, just to answer that one question, elaborate on that, I'm going to spend virtually half the day just on what properties to target. So just one last question at the back.
Thanks, Konrad. Just a quick question. Do you know aware of any banks in Australia that provide finance for investing overseas? Because some banks have restrictions on why they lend money. So if you want to purchase a property in, say, the United States, but want to acquire finance here...
They won't do it. The reason they won't do it is because they can't take a deed of charge over the asset, meaning they can't repossess the asset. So there are no banks that will do that because they haven't got legal authority to repossess the asset and sell it in the case you default on the loan. So the answer is no banks will do it. You can do it the other way. I mean, banks in Australia are happy to lend money to overseas investors to buy property in Australia, but the other way around just doesn't work, just purely from... Because remember, when banks lend you money for a house, they always look at the worst case scenario. What happens if the deal goes bad? How do we get our money back? And if NAB were to give you money to buy cash flow positive property in the US, it would be virtually impossible for them to repossess those properties and sell them, number one. Number two, they haven't got the infrastructure set up to actually value those properties and assess them accordingly to what they do in Australia. So I don't think it's going to happen in the future either. I just think it's too hard for them to do so, and it's too complex to set up. Yeah, but it's a good question. Okay, so let's continue on. So we just looked at character. The character has to do with your ability to borrow money. And like I said, the most important thing is for you to get a copy of your credit file. It's a free service. If you're a serious investor, you should go on your mycreditalert.com.au. $45 a year, tax deductible. Anytime anyone marks your credit file, you get a copy sent to you off that page. Now, if you've got an unusual name, like there's not many Konrad Bobilaks in Australia apart from me, right? But if your name is Adam Smith, I mean, I've seen where people had marks that weren't even theirs on the credit file and they weren't aware of it if they had a very popular name. So, so you got to be ultra diligent with this, and this is the most sensitive part of lending. The next one is equity. How much will you put into the deal? Generally speaking, the banks in Australia are happy to lend you up to 80% against residential property because they know whatever happens, if they put it back on the market, they can get their money out of the deal. So 80% is roughly where it's at. As long as you've got a 20% deposit, and this is the thing about building large property portfolios, and I'm about to show you the two formulas that you need to be aware of when you're buying a property, when you're building a property portfolio. But as long as you satisfy the DSR ratios and LVR ratios, which I'm about to cover, and you can come up with a 20% deposit plus around 5% closing costs, which is about 25%. So $500,000 property, it's about $125,000. The banks will just give you virtually unlimited amount of money. Because remember, for them, there's no risk. Providing there's no postcode restriction on the property, and the property is a residential property, as we discussed before, there's no limit to how many properties you can buy and hold. Providing you satisfy these two criteria as well, which I haven't covered yet. The moment you borrow above 80%, you have to pay for the privilege of doing so. And basically, the moment you do borrow above 80%, you have to pay what's called lender's mortgage insurance. Now, there are two main underwriters of lender's mortgage insurance in Australia. It's Genworth and PMI. And also, banks self-insure lender's mortgage insurance internally. Now, a lot of people don't know, but GE and PMI also have a file on the individual that borrows money to buy investment properties. But no one can get a copy of this credit file. It's actually a file that, I guess, it actually monitors the amount of debts that you have. And roughly, GE and PMI will cap your exposure to that particular underwriter of LMI at about 2.5 million each. So the moment you hit 2.5 with one of them, your loans will become rejected, and they'll say you're too rental reliant on your serviceability, which is a BS excuse. It's just a saying, we don't want to have more exposure to you as an individual. You've got 2.5, 3 mil, that's all we're comfortable with giving you. So remember I said before, your success as a property investor will be largely determined by the types of questions that you ask your mortgage broker. Because here's the thing, I'm going to show you in about half an hour why interest rates are not even real, they don't exist, okay? But this is what the types of phone calls we get. If we get a phone call, someone says, hi, 21st Century Finance? Yes. What's your cheapest rate at the moment? I already know the person has no idea about what they're doing. Or compared to, hi, I want to know, I've already maxed out with G as the underwriter of LMI. I want to get a loan at 95% where the underwriter of LMI is PMI. It's already a different discussion, would you agree? So if you're going to for all these loans and you've got you're going with St. George, NAB, remember they all use the same underwriters for lender's mortgage insurance. So you have to be aware with every loan, who is the underwriter of the lender's mortgage insurance? And if you're aggressively building your property portfolio, this is one of the reasons people max out, which is just basically having too much exposure to one of the underwriters of lender's mortgage insurance. So if you're getting to 2.5 million with GE, you should be looking for loans that are underwritten by PMI. You've got another 2.5. Then if you maxed out with both, you can go for Westpac or CBA or St. George, who also can underwrite the lender's mortgage insurance internally. Now, a lot of brokers don't know this. And in fact, with St. George, for example, when there's a few other lenders, you can actually choose who you go with. Like CBA does it, NAB is the same. So you can choose whether you go for this department, that department. That's when your relationship shouldn't be so much with a broker, but you should have a relationship with a banker. So the more advanced you get and more aggressive, I guess, you get in building your property portfolio, that's when you need to establish relationship directly with the bank manager who has the ability to do outside of policy lending. So you need a person who has a delegated lending authority of $1 million plus or 1.5 million. So when I go to a bank, the first thing I say is I want to speak to someone that has a DLA of 1.5. Because I know the person can approve a $1.5 million loan on the spot. If I'm buying a property for $800,000, for example, would I want to speak to someone that can only give me, that has a delegating lending authority up to 200,000? But see, people don't even know who to go to. They don't even know what to ask. Would you agree with that? And they end up talking to some person behind the counter who's done 3 days worth of training with the bank, telling them they can't do anything. So the higher you get in the bank, that person would have more discretionary lending, he would know credit better, and he'd go outside of policy. I'll give you an example, just with cars. It's a very simple example. I used to work for a company called Medfin, which is a subsidiary of the National Bank, and all we did was medical finance, and I used to do a lot of car finance. Now, car finance is so competitive, there's virtually no margin in it, okay? Because every Tom, Dick and Harry is doing it. And the typical phone call that we used to get from clients would be a dentist calling up saying, or a doctor saying, I'm about to buy a BMW from BMW Melbourne. They're offering me 4.25%. Can you beat that? Now, I know for a fact that at the time that I was working there, the cost of funding was about 6.15%. So how is it possible for BMW Finance to do a deal at 4.25 on the brand new BMW? Where would they load up the price? Yeah, ask them to do I want to buy a Mercedes using BMW Finance at 4.25. So what I used to do, just to get the client on our books, so I could have a look at their other things and refinance the whole practice and help add value to them, I would actually undercut BMW Finance and do it at a loss. Do it at 3%, I don't care. Now to do that, I had to get permission from credit and my manager. So on that actual deal, we would make a loss, but I knew that the moment I had that relationship, I could go in and potentially refinance the practice, do a dental chair, do you understand? Grow a whole relationship. So the higher you get in the bank, the more discretionary lending you have, the more ability to do things outside the square. The lower you get, everything's impossible. Nothing's impossible until someone does it. Would you agree with that? Then it becomes a benchmark. Now, there are some things that credit just wouldn't do because it's not worth the risk. But this is the thing, I find that the most successful property investors that I used to look after, and I'll tell you tomorrow, I'm going to go through specific examples, most of them were successful because they had one or two really good relationships with bankers and they could do outside of policy lending for them. They could bend a few of the rules to get them across the line because they knew it was a greater relationship was at stake here. And that's what I would recommend you do. So when you're starting off, brokers are the best. Later on, you have to go direct. Forget about brokers because they can't do any outside of policy lending. They can only submit loans based on the criteria they have. They won't even try to put the application in if it doesn't fit 10 out of 10 boxes. Where what I used to do is as long as it ticks 7 or 6, I could push it across and do it. Okay, so just getting back to that. So you've got to be aware that with the lender's mortgage insurance, now lender's mortgage insurance, if we just go back to the slides, is a one-off payment that you pay for the privilege of borrowing above 80%. So the bank is basically saying to you, listen, I'll give you 80%. If you want to borrow 95%, we're not sure if the property market could potentially drop by more than 5% short, medium term. So we're going to insure our position, which means we can sell the property, get 80% from the market, and then for the other 15% we'll go to GE, PMI, and self-insured department. But what your role is, as an investor that's growing their property portfolio, you have to start asking those types of questions, and your broker should be able to answer and tell you that this loan is being underwritten by this LMI underwriter. Turn to the person next to you, explain equity, LMI, and also the fact that there are 3 in the industry. 30 seconds. Okay, take the person next to you. Let's continue on. Now, the question is, what's the maximum that I can borrow today? The maximum that you can borrow from one product is 97% through Bankwest or 95% from CBA, but you have to be with them for 6 months. But generally speaking, the market average is 90% now. That's the maximum you can borrow. Can you still do 105% finance? Absolutely you can. Absolutely you can. You just do 2 loans. Okay, it's not even rocket science. So you do 1 loan for 15%, 1 for 90%. Now, tomorrow I'm going to get into product-specific loans that you can do both. Now, Bankwest, for example, and St. George, before the subprime, actually had a product which was a combination of a personal loan for 10% and a 95% mortgage. So these products are standard in the industry. They're just not, I guess, they're not advertised readily and a lot of people are not aware of them. You can always get 105% finance. It just depends on how creative you are and how much knowledge you have. The more knowledge you have, the less money you need to use. That's what I find. So the funny thing about building a large property portfolio is you start off using a lot of money. In fact, most people put in 20% because they won't pay the LMI costs because they think it's 1.5%, it's 10 grand, let's just save more money and put in 20%. Then as you get advanced, if you do become one of those minority people that actually be able to get past 5 properties, you start using less and less of your money. And when you become a sophisticated property investor, you use virtually none of your money. I'm going to show you a couple of deals that I did where not only did I use $0, I actually cashed out of the deal on settlement. So I'm not talking about no money down, 0 money, and took money out of the deal on settlement. At disbursement, money was transferred into my bank account. So I'm going to show you those deals, but that just comes with knowledge. No one's going to teach you this stuff, and plus no one's going to do it. People say, can you get me one of those deals, Konrad? Well, if I get one of those deals, I'm going to do it myself. Definitely not going to give it to you. Okay, so let's talk about the 2 things that you need to satisfy, and these are the 2 things that limit people from buying more property, and these are the formulas that are used by the banks. Now, LVR is just easy, it's common sense. So let's have a look at a scenario where you've got a couple that are working and they've got a $500,000 owner-occupied property and they're buying another investment property for $500,000. And this is how easy LVR calculations are. So you've got a property price of $500,000. Say you're buying it off the plan. In Queensland, you pay $15,225 in stamp duty. So let's say it's a typical 500 square metre block in a brand new estate. The borrowing cost, $4,500. Let's say they're using a trust to buy this property in. Now, Warren Blake's going to be here today talking about trusts, benefits, the good, the bad and the ugly, whether you should use trust to purchase property, what are the implications of selling property in trust, etc., and different types of trusts that are available. So your loan is $519,725. And then what you do is you work out your assets versus your liabilities. So you've got your investment property, which is 500, and let's say you've got a home with 500 as well. So you've got $1 million worth of assets, correct? And then you've got a mortgage on your home loan for 150 that's left over. So the value of the properties that can be mortgaged is $1 million. 150 plus 519,725, 669,725. So your LVR is 66.97. As long as you keep your LVR below 80%, you won't get rejected by lender's mortgage insurance. Now, a lot of people don't know that with low doc loans, the entire loan is actually insured by lender's mortgage insurance. It's just that in some instances, you don't have to pay for it up front. It's actually incorporated into the interest rate. And I'm about to cover different types of loans. So that's LVR, very simple. You've got $1 million worth of assets, you've got 669,725 worth of debt, so your LVR is 66.97. Your goal as an investor is to keep your LVR below 80%, long term as a property portfolio ratio. That means that it's very easy for you to borrow up to 80%, get a line of credit, and LMI doesn't come into the equation. The hardest one to explain, and this is the one where I had to really generalise because every lender in Australia has a subtle different way of working out serviceability. So I've generalised it, and I try to look at most of the lenders and work out, okay, how do they work out DSR ratios? And I try to have one formula that blankets all of them, which is it's very difficult to do. So I've come up with a summary of how DSR ratios are worked out. DSR ratios are where the majority of people get rejected. So let's say, for example, you've got a home loan repayment, interest only, you've got 150 grand, whatever it is. Say you're paying 9 grand a year. It could be 20 grand, it could be 40 grand.
So what's DSR?
Debt serviceability ratios, which I'm about to explain. So DSR stands for debt serviceability ratios, or debts to serviceability ratios. Let's say you've got a car loan. So if you've got a car loan, whether it's a chattel mortgage or a hire purchase, novated lease, or a personal loan, your annual repayments just get added to your total repayment. So what we're doing here is we're just working out per year how much are your total repayments on everything. That's what we're working out. Personal loans, credit cards, car loans. If you've got an investment property from the previous slide, let's say you're doing an interest-only loan on 500 grand, it's going to cost you 31,183.50 per year. It could be anything. I'm just throwing in some numbers. So we're working out your total repayments on all your debts, or one section. If you've got a personal loan, that would be in here as well. If you've got a credit card, that would be in here as well. Now, credit cards are tricky because if your credit card is linked to an offset facility, which I haven't covered yet, and it's getting automatically paid out every month, it doesn't necessarily appear on this equation. But if it's a credit card that's just a standalone credit card and you've got a limit of $10,000, but you've never used that credit card, or it's just a credit card in case of emergency, they would put $10,000 here. They'll assume you've maxed out your credit card. So if you've got 4 credit cards at 10 grand, but you've never used them, that doesn't make a difference. That's 40 grand automatically on this part of the equation. Then we work out the eligible joint income, and this is the section that I had to kind of improvise with because every lender has a slightly different way of calculating this section. So let's say you've got Bill and Mary and they're on $50,000 each before tax. So they're on $100,000. The actual lender will take only 30% of their annual income. And then they'll take 80% of the rental that they are getting on the property. Not 100% because you've got overheads on your rental, haven't you? You've got property management fees. In Melbourne, it's roughly about 7% plus GST. You've got body corporate fees, etc. So if you're getting let's say you've got a property with $500,000 and you're getting a 5% rental income, that's $25,000. 80% of 25 is 20,000. Now, by the way, on Wednesday, we're going to email you this entire PowerPoint presentation. So you don't have to frantically take down every point. If you don't get it on Wednesday, just give us a call on Thursday. So make sure that you've given us your accurate email. Sometimes people ring up and say, I haven't got anything. And when we checked the registration details, the email address was written in such a way we couldn't read it. Because remember, someone has to data entry that email on Monday and Tuesday. So you will get this PowerPoint email to you. It's 360 slides roughly. So you don't have to frantically take everything down. Just take the main points down, just to remember what we're talking about. So your total eligible income is $50,000. So we're looking okay, aren't we? 30% of your wages, 80% of your rentals. So then what to work out the debt service ratio, we get the loan repayments, which is $40,183, divided by total eligible income. And that gives us a percentage of 80.36. Your DSR has to be below 100. Now, some banks like ING don't work out a percentage, it has to be positive by $1. So you have to have $1 left over. Okay, so there's variations, but this is it. So to summarise, your LVR ratios, you want to keep them below 80%, and your DSR ratios have to be below 100%. If you can satisfy both criteria and have the funds to complete the transaction, you can virtually borrow an unlimited amount of money. Now, this is the most important thing, and I said to this, the biggest misconception in property is this. People believe that their income has a lot to do with how much they can actually borrow. If we just go back to the previous slide and we look at the DSR ratios, What's more important in the equation? Is it 30% of your wages or 80% of your rental? Yeah. So what's going to service your property portfolio acquisition after your first 1, 2 or 3 properties? It's your rental. It's never going to be a PAYG income. So this is the thing, whether you're on 30 grand, on 100 grand or 300 grand, it's irrelevant after the 5th, 6th, 7th property. Okay? Unless you're going to be making $4 million a year, and even if you are, you've got to declare it, which means you'll be a complete idiot if you do. Okay, so this is the thing, people think, oh, he's got 40 properties. Well, 40 properties, to service 40 properties just on your income, you have to be in the millions of dollars per year. This is why I say the most important thing about investing is just to start, number one. Number two, just get in the market, get the equity, get the rental going, because after your first, second or third purchase, your income is irrelevant in the equation. It's always going to be the rental that's going to be driving your future acquisitions. Now, for those who have 2 or 3, how many people here have over 3 properties already? Okay, great, congratulations. How many have more than 5? For those who have more than 5, I'll definitely recommend you buy yourself Jan Summers PAA Pro software, because in that software, it actually has debt serviceability ratio calculators. And what you can do, if you're really good friends with a mortgage broker, you can start pre-programming different lenders' DSR ratios, because depending on what criteria you put in, you can borrow with some lenders and some, so you can start working out your own serviceability. This is only for people that have got about 5 plus. If you're getting your first 1 or 2, you don't need to do that. Jan Summers, I'll give you the website tomorrow and I'll actually show you how to use the software. It's called Jan Summers Property Investor Analysis Software. It's the pro version. It's $475, I think. So that's when you can start getting creative. Now, this is a very important part of what we're going to do, because what I'm going to show you is, if you understand the fundamentals of these 2 lines, when you start buying property, you're going to start targeting properties that have the highest rental yield. Okay? I'm not talking about cash flow positive property. I'm talking about the highest rental yield. There's a distinction between that, and I'll show you why. Actually, so turn to the person next to you and just discuss LVR and DSR for 30 seconds and the importance of these 2 equations before we go on. Okay, coming back. Now let me give you another I'll give you a very important distinction, and I'm going to give you these distinctions throughout the 2 days. Sometimes we have clients where they've got a couple of credit cards, emergency so-called credit cards, for $10,000 or $20,000 they never use. Now remember, it's regardless whether you use them or not. The moment you've got it, the maximum amount gets put into the equation. So sometimes the best thing to do, and this is what we do with our clients, is if you've got a $10,000 credit card, ring up the bank and reduce the limit to $1,000, get the approval, settle the property, and then increase it back to $10,000. Okay? And that sometimes is the difference between getting across the line. Or if you have a car loan, for example, because remember, we're talking about repayments per year here, aren't we? If you've got a 5-year car loan, sometimes what we've done is we tell the client, sell your car, get the loan, buy another car. Because all that matters in banking is where you are at the moment of application. Debts, assets, liabilities, right? That's all it is. So sometimes it's even refinancing your car loan. If you don't want to get rid of it, refinance it on your mortgage, because your repayments over 25 years will be much lower than over 5 years. Would you agree? So your personal loan, your credit card, your car loans kill your serviceability completely, because they are bad debts. And I'll talk about good debt and bad debt. So what you want to do when you're applying for a loan, you want to minimize your outgoings, maximize your money that's coming in. Remember, when they assess your first investment property, so when you're buying your first investment property, they already put in 80% of the rental income. The rental income is usually calculated at 4%, unless you get a property manager giving you a written rental appraisal. Now, got to be careful what I say here. I'm really good friends with my property managers. Right? it's amazing what they can put on writing when I'm going for loans in terms of the rentals that I can get. So become friends with property managers. The letters that they write to you, they're not really legally binding, okay? It's just an opinion about the market. But remember, the rental market, depending on the property that you buy, there's always a range, isn't there? There's an upper range and a lower range. So if you can squeeze out 4.5% on a rental appraisal letter versus what the bank default will be 4%, is that going to increase your serviceability? Absolutely. So number one thing is with DSR ratios is get rid of credit cards are a killer, number one. Reduce them, reduce the limit. Now the funny thing is don't get rid of them because the banks, they do this thing where if you need money, the banks won't give you money. But when you don't need money, they'll throw money at you. Who's had that experience? So don't reduce your facilities, always have them there. This includes lines of credit, which I haven't covered yet in detail. You just want to reduce the limit to the minimum because you don't want to get rid of facilities. You want to always have them established, but just have them at a minimum because it doesn't really hinder your lending ability. So the most important thing in building a large property portfolio is your rental amount that's coming in. And I've said this before, but your wages are virtually relevant. They're only relevant for the first 1 or 2 or 3 acquisitions. After that, it's irrelevant in the equation. So when we talk about lending, this is what we talk about inside and outside the box lending. Inside the box lending, we have full doc lending. This is what the banks love to see. Clear history, consistent stable income of 2 years, you haven't moved around a lot, and you've got a full employment contract in the same industry for more than 2 years. Now, the reality is most people don't fit this criteria. Okay, the average, I think now, job is about 12 to 16 months. People move around a lot, they change industries, etc. That's why we have all these other types of loans. We have no doc lending through non-conforming lenders, low doc lending, credit impaired lending, vendor finance and solicitors funding. Most people, when they come to me and say, Konrad, I've been to the banks, I can't borrow any more money. I said, well, how many banks have you been to? I went to CBA in St. George. I walked in and I said, no, you can't do anything. There's thousands of lenders in Australia, literally thousands. And I'll show you the lenders that exist in Australia, and I'll show you the fact that most brokers only deal with the lenders that are on their aggregation list. So with Plan, for example, there's only 36 lenders. Okay, now I'll show you a list of over 200 lenders that are lending money today actively. Most of them don't aggregate with brokers. They don't pay commissions to brokers, therefore brokers are not aware of them. Aggregation is basically where it's basically a company that brokers use to make sure that they have access to 36 lenders using one software and they get paid commissions every month on time. So it's like a union for brokers. It's a company and they take a small cut of the actual loans. So most brokers don't go directly to banks. They actually go through an aggregator, which is a middleman, and they basically have access to all the different loans from 36 lenders. Otherwise, it's just too difficult to establish 36 independent relationships with different lenders. So let's go through different types of loans. So I had a question before, what's still available in the market? Who asked that question before? Yep, so I'm about to cover that now in detail. So low doc loans. Low doc loans, which are virtually gone now from the market, are loans whereby the borrowers cannot demonstrate financials to service their debt. However, they do in fact earn the income to qualify for the loan. Borrowers must sign a declaration to the lender disclosing the per annum income. So you sign a stat dec saying I'm making 100 grand a year, but they don't need to provide financials. And you can still borrow up to 70%, 80% historically, now it's about 70% through ANZ. But these loans that we have today are not the true low doc loans of 2 years ago. So these loans were created for people, typical tradies, the plumbers out there working for 4 years. Any plumbers in the room? And they haven't done their tax returns for 4 years, but they're making money. Okay? It's basically, this loan was specifically designed for those people. They sign a state deck saying, look, I'm making 100 grand, I'm behind my tax returns, I'm good for it, give me the money. Because of the subprime, and because of the reaction of the banks in Australia, which really there was no need for, because we're so separate from the US now, we're pretty much independently running, they got rid of all these loans. So they're virtually gone. Low doc loans, so that's low doc loans. So low doc loans, now you actually need 2 years base statements, 2 years financials. No doc loans are whereby the borrower cannot demonstrate financials, they don't want to disclose any income, and they sign a declaration, not even how much they're earning, that they can afford the repayments. So this is what we used to refer to as an asset lend. It's basically the person saying, look, I don't want to talk about how much money I'm making, don't ask me any questions, I just want to buy this property and I'm going to put in a 30% deposit and closing costs, and the bank just assesses the property, they get a valuation. There are restrictions on no-doc loans historically, meaning they cap lending per suburb based on median price. So you can't go into a suburb that median price 500 and buy $1 million property. They'll give you a range, they'll give you a conservative valuation, and based on that, they'll lend you the money. But these loans were historically asset lending loans, meaning the individual's really irrelevant. They're looking at the property, they're looking at the ability to resell the property. Historically, you could borrow up to 70%. There are still a couple of people in the market with no-doc loans, but they are truly low-doc loans. And they're not even the low-doc loans of 2 years ago. So these types of loans are virtually now gone. So low-doc loans are still in the market, but you need 2-year financials. And this is putting more pressure on the property market because there's a lot of self-employed people out there that either they can't show their income for the last 2 years or they don't wish to show their income for the last 2 years, which means they have to rent because no one's going to give them money. And that, I believe, has put a lot of pressure on especially inner city suburbs around the major capital cities of Australia. The moment that changed, we saw a spike in capital growth, we saw a spike in the rental yields in different major capital cities. Now, we're about to watch a short video on the, some of you might have seen this before. It's an interesting video because I've actually been playing this video for the last year and a half, and it's as relevant today as it was relevant a year and a half ago. It actually talks about the subprime fallout in the US, and it actually gives you an insight in terms of what actually happened. It's only a 7-minute video, I think, but it shows you a good illustration of what actually happened in the US and why, and I'm going to talk about why it could never happen in Australia. Because there's been a lot of publicity in the media a year ago about the same thing happened in the Australian market that could happen in the US market. So we'll talk about that after the video.
Ladies and gentlemen, John Bird and John Fortune.
George Parr, you are an investment banker.
I am, yes.
Yes. And as such, you have your fingers right on the pulse of the financial market.
Yeah, very much so, yes.
And during the summer, there's been a great deal of turbulence and volatility
in the market, yes. Tremendous, yes, tremendous.
Yes, and what has caused that?
Well, you have to remember two things about the markets. One is that they are made up of very sharp and sophisticated people who, these are the greatest brains in the world. And the second thing you have to remember is that the financial markets, to use the common phrase, are driven by sentiment.
What does that mean?
What does that mean? Well, things, let's say, are just going along as normal in the market, and then suddenly, out of the blue, one of these very sharp and sophisticated people says, "My God, something awful's going to happen! We've lost everything. Oh, my God, what are we going to do? What are we going to do?
Shall I jump out of the window?
Shall I jump out of the window? Exactly. Let's all jump out of the window.
Sell.
We've lost it.
Sell. Yes.
Precisely.
Yes.
Precisely. And then a few days later, this same sophisticated person said, "You know, I think things are going rather well." And everybody says, "Yes, I agree with you. You know, I think we're rich. We're rich. Yes.
Rich.
Yes.
Buy.
Yes.
Yes,
and that's what we call market sentiment.
Yes. Surely we are exaggerating just a bit, aren't
Well,
we?
I don't know. I mean, in August, in the middle of August this year, when the market absolutely plunged in London, a well-known city firm, State Street Global Markets, issued a statement in which it said, and I quote, "Market participants don't know whether to buy on the rumour and sell on the news, do the opposite, do both, or do neither, depending on which way the wind is blowing," unquote.
Yes, and this is the kind of rigorous analysis that companies will pay huge salaries for.
Yes, exactly. And a few days later, when the markets had gone up a little bit, the senior equities advisor on ABM Ambro Morgan said, and I quote, "We're back to happy days again."
Well, no price is too high
For that, no.
for that kind of
And
mature wisdom,
certainly
is it?
not. And this sort of people are paid millions of pounds in bonuses.
Yes, of course. During this summer, there have been actual causes behind the volatility in the markets,
Yes,
haven't there? I mean,
yes.
specifically and especially in America, granting vast numbers of mortgages to people who can't afford them
Yes.
on properties which are diminishing in value.
It's the so-called subprime situation, yes, the subprime market.
Yes. How does that work, in fact?
Well, imagine, if you can, say, an unemployed black man sitting on a crumbling porch somewhere in Alabama in his string vest, and a chap comes along and said, would you like to buy this house before it falls down? And why don't you let me lend you the money?
And is this chap who says this, is he a banker?
Oh, no. He's a mortgage salesman. His income depends entirely on the number of mortgages that he can arrange.
So his judgment to arrange mortgages is completely objective?
Completely objective, yes, absolutely.
It would. Yes.
Yes.
And what happens next?
Well, then this debt, this mortgage, is taken, bought by a bank and packaged together on Wall Street with a lot of other similar debts.
Without going into much detail about what is actually...
Without going into any detail, no, it's far too boring. And so this is put into a package of debt, and then it's moved on to Wall Street, and this is extraordinary what happens then, that somehow this package of dodgy debts stops being a package of dodgy debts and starts being what we call a structured investment vehicle.
An SIV?
An SIV, exactly, yes.
Yes, I see. And then someone like you comes along and buys it.
I buy it, yes, and then I will ring up, I don't know, somebody in Tokyo and say, look, I've got this package, do you want to buy it? And they say, what's in it? And I say, I haven't got the faintest idea. And they say, how much do you want for it? And I say, $100 million. And then they say, fine, that's it. And that's the market.
And presumably this package, I mean, that kind of thing can happen several times to the same
yes, it could
package.
possibly, yes.
And every time it does, of course, then you or someone like you will get a fee and a markup
And a profit, yes.
And
Well,
so
you can't
on.
expect us to do it for nothing. It's hard work.
In view of the fact that in these packages is a lot of dodgy debt, what is it about it that attracts the financial, risk takers?
Yeah, well, because these hedge funds, as they're called, which specialise in these debts, they all have very good names.
You mean they're responsible companies?
No, I don't. It's nothing to do with their reputation. They have actually very, very good names. The names they think up for them are very good. I'll give you an example. There's a very well-known American Wall Street firm called Bear Stearns, who have two of these hedge funds which specialise in these mortgage debts. And they lost so much money, lost so much of its value, that Bear Stearns announced that they would have to put in $3.2 billion into one of the funds to try and keep it afloat.
$3.2 billion?
3.2 billion, yes. And even then they said the investors couldn't get any money out of it and they were going to let the other fund go. But one of these funds was called the High Grade Structured Credit Strategies Fund, and the other was called the High Grade Structured Credit Enhanced Leverage Fund.
Well, that sounds very good.
But that's good, isn't it? Yeah.
It sounds very trustworthy.
Actually, this is the magic of the market. What started off as lending a few $1,000s to an unemployed black man in a string vest has become a high-grade structured credit enhanced leverage fund.
I like the sound of it.
It is good. Well, it sounds very trustworthy. I mean, it's got good words in it. It's got words like high.
High is good.
High is good. Yes. Better than low, anyway, isn't it?
Yes, absolutely.
And structured is another good word.
Very good.
Enhanced is...
I love enhanced.
Enhanced is very...
I mean, I'd buy anything if it said enhanced.
Absolutely, yes.
Yes.
It might have been different if it said the unemployed black man in the string vest fund, but
yes, because then alarm bells might start to ring. But despite these very plausible names, surely the reality is that the people that lent all this money have been incredibly stupid.
Oh, no. The reality is that what was stupid is, for some point, somebody asked how much money these houses were actually worth. I mean, if
stupid.
they hadn't have bothered to ask that question, then everything would have gone on as perfectly normal. But unfortunately, they did.
I see, but now you see people are saying the crisis is likely to turn into financial meltdown. I mean, can that be avoided?
It can be avoided, provided that governments and central banks give us, the financial speculators, back the money that we've lost.
But isn't that rewarding greed and stupidity?
No. It's rewarding what the Prime Minister Gordon Brown called the ingenuity of the markets. That is
You see, and
we don't want this money to spend on ourselves. We want this money just to go into the market so that we can carry on borrowing and lending money as if nothing had happened without thinking too much about it.
yes, but if the worst came to the worst and you didn't get this money, what then?
Well, then there'd be another market crash, and then I would say to you what people like me always say, that it's not us that will suffer, it's your pension fund.
Thank you very much, George Parr.
A pleasure.
Okay, who enjoyed that? It's actually, as funny as it sounds, it actually is pretty accurate in terms of what actually happened. And I want to mention this because it's very important, because there's always been parallels drawn between the US market and the Australian market. And apart from the diminishing population, etc., there's a lot of differences. I want you to understand the difference between the lending institutions and the lending policies that are in place in Australia versus the US, because they're very much fundamental. So if you look at different types of lenders in Australia, we have your prime lenders, or your mainstream lenders, which are your major four and your banks. And then you have your subprime lenders, subprime market in the US. In Australia, we refer to that as a non-conforming sector. Now, if you look at the types of loans, what they were doing in the US were doing basically no-doc loans on owner-occupied properties, and they were offering honeymoon rates for the first 12 months, 2 years. So imagine the interest rate is 7%, they were doing them at 2.5%, 3%. With the notion of the property is going to go up in value in 2 years' time, you revalue the property, refinance, and continue on your way. They were completely driven by commissions. Now in Australia, mortgage brokers can get their commissions clawed back. In America, it doesn't happen. So in Australia, it's 100% clawback. But the most important thing is this. The subprime sector in America was around 29% of the lending market. In Australia, it's about 3%. And in Australia, 100% of that 3% is insured and underwritten by lenders' mortgage insurance, which is GE, PMI, or self-insured. And last year, they had a default rate of less than 1%. Is that a much safer environment compared to the US? Absolutely. The problem with the property market is this, that there is no such thing as the property market. When people say the Melbourne market did 11.3% last year according to RP data, well, Melbourne is not a market, because in Melbourne we've got Toorak, where the average house sells for $12 million, and we've got places like St Albans where properties sell for $380. So can anyone tell me what the correlation is between a person, whether it's demographically, economically, living in St Albans versus Toorak? Like, how can you link those two suburbs together? So when people talk about markets, the first thing you've got to do is, and I'll cover this tomorrow, about what statistical data you should be looking at when you're analysing trends, because most of the statistical data is just BS. It's irrelevant. Bless you. That's number one. There's no such thing as the Melbourne market. The Melbourne market is different suburbs. They have nothing to do with each other. Some suburbs are going up, some going down. Some are going sideways, and they've been going sideways for years. So to me as an investor, when people say Melbourne did 11.3, it doesn't really mean a lot of things to me. I want to know what my suburbs did, what the streets that I've got properties in have actually done last year, and the ability for me to revalue those properties. But the most important thing is, when we look at different markets, our financial system was completely restructured following the 87 recession. Our policies are completely different to the US policies. And this segment of the subprime, which is our non-conforming segment, is a tiny fraction of our lending market. So the exposure was never there. So for anyone to try to make any kind of correlation between the US market and the Australian market, automatically I know they have no idea about the banking system. They've never worked there, they have no idea what's happening. The second thing that's happening is this. there's a lot of academics coming out of the woodwork now saying that the property market in Australia, because it's going up so quickly, is not sustainable long term, because there's going to be a bubble. Because weekly or annual income is not growing at the same rate as the property market. Therefore, it's unsustainable. And this is what economists do. They say, okay, the average income is growing at 3.5%, property is going at 10%. There's a gap of 7% or 6.5%, it's unsustainable, right? Now, the funny thing is that in Melbourne, for example, and I'll use Melbourne as an example, but it's the same in Brisbane, it's the same in every major capital city. If you look at a very affluent suburb, and I'm going to take not the most expensive suburb, but I'll take a suburb like, I guess, Kew, which is probably like Hamilton here, okay, where the average property is between, I don't know, 850 to 1.5 plus, okay? If we take a family and the properties are worth 1.5 mil, people that buy in Kew, that's not the first house that they bought. That's probably the second, third, fourth, fifth property. And what they've done is they're rolling equity over from the previous property into that property. So when we do a loan for owner-occupied properties in Kew, we don't do loans at 1.5 million. We usually do a loan for 200 or 300, and they roll over the equity from the previous suburb. So if you look at Kew, for example, let's say this is a cluster of different suburbs. And this is Kew. And the average in Kew is, and I'll talk about RP data tomorrow, so 1.2 million. 70% of Kew is owner-occupied. It's people living in the house, okay? There's only very few investment properties. So the only way you could devalue is if a family woke up there one day and say, honey, you know how our kids go to private school and we live in one of the best suburbs in Melbourne? Why don't we sell our house for 1.5, go out 60 k's from the city and take our kids and put them into public schooling and just live in the house for 350,000? Is that likely to happen? What do people always do with cars and houses? Upgrade. They roll equity from the previous one, they put it into the other one. So when people say, well, how could South Yarra possibly go for $2 million, or how could Brighton keep going to $4 million? It's going to go to 4, and then it's going to go to 10. It's going to go to 12, it's going to go to 15. Look at Sydney, look at Darling Harbour properties. Why is it possible? Because the people that are buying in those suburbs, they're not getting a first home buyer's grant. They don't go, hi, want to buy a property in Darling Harbour. It's 23 million minus the 16,000. Is that what they do? The other thing is that if you get over $800,000, it's not really a mortgage market either. It's very difficult to actually borrow in excess of 800, 900,000 for an owner-occupied product. Why? Because there's no rental in your property. Would you agree with that? So when they're assessing your serviceability, they're looking at purely at your income. So the moment you're looking at a $1 million property plus, even if you're doing 80%, that 80% is very difficult to obtain for an owner-occupied property. Because remember, if it's an investment property, what else is added to your serviceability before you even bought it? Your rental. You're getting 80% of your 5% rental or 4% rental on that property. So this is the thing, there's two factors that I believe will drive property prices upwards indefinitely until they are as high as London and New York. It's human greed and the constant upgrade of properties. People always go from better, better, better. They never go the other way, do they? They don't start up getting a Beamer and then get a Camry the next year, do they? They upgrade, right? Because of suburb, location, lifestyle, prestige, schools, okay? Number one. But the other thing is this. If you look at DSR ratios, let's go for $1 million. If you got 1 mil as owner occupied, to service that debt, because you've got no rental coming in, you've got to take 30% of your wages to service that actual debt. That really is not a mortgage market anymore. There's only a very small fraction of the population that could actually service $1 million worth of owner-occupied debt without any equity from the previous property. If you're buying an investment property for $1 million, it's not only 30% of your wages, or your wages could be irrelevant by this stage, it's 80% of your rental. So if $1 million at 5%, that's $50,000. 80% of that, you're getting $40,000 in serviceability from your rental. So economists that come out with these ideas saying, you know, your wages are growing at 3% and property prices are growing at 10%, it's unsustainable, it's BS, because what they don't understand is that when people buy these properties, they don't go for a loan for $3 million. They're rolling equity from the previous sale. And they keep rolling equity into rolling equity. So when you think a suburb is too expensive now, in 10 years' time, and tomorrow I'm going to show you the last 100 years of capital growth. 10 years' time, it's going to double again. And again, people are going to be saying the same thing. I can't believe it's worth $2 million. Can you believe it? It's never going to go up past that. Guess what's going to happen in that year's time? 4 million. Because the people that have bought in that suburb, think about it. If you've got two suburbs, for example, one suburb is $1 million and the second suburb is, say, $2 million. Okay, this suburb in that year's time, at 10% capital growth, the median price will be 2 mil. This is the same, this is 4 mil. So these people will try to get into that suburb, taking the equity from the previous suburb. And 70% roughly of that suburb are owner occupiers. That cycle cannot be broken. It's virtually impossible to break that cycle. It'll be as ridiculous as these people going out in outer city areas and going, we're going to downgrade our school, our lifestyle, our whole suburb. That will never happen. So this is the problem with the property market. When you look at the property market, there's so much misinformation about it, because if you ask a real estate agent why a particular area did so well in the last 10 years. For example, in Melbourne, Williamstown has quadrupled in 10 years. It went from 200 to 800, okay? It's the first suburb west on the Bayside. If you ask a real estate agent and say, why did Williamstown do so well? They'll say it's location, location, location. It's 7 k's from the city, it's picturesque, it's got heritage properties, etc. If you ask a banker, for example, why Williamstown did so well, they'll talk about capital growth and interest rates. And they'll justify capital growth in Williamstown based on their perception of the world, which is based on interest rate. If you ask someone that studies demographics and population trends, they'll tell you about scarcity of land. There's no land left in Williamstown. There's pressure on housing there, etc. So who's right, who's wrong? You've got all these different individuals coming out with all these theories, and all these theories make sense, and sometimes they're in conflict with each other. I have stopped trying to understand the property market a long time ago, why it does what it does. And tomorrow when I talk about property selection, I'll just show you statistically what I do, how I select properties and why, and then I just hope it's going to happen. Okay? Which means I'm stacking the odds in my favour, and I'm betting that it's going to double in 10 years' time. But if it triples or quadruples, that's even a bonus. Because no one could have predicted that Williamstown would have quadrupled in 10 years' time. No way. Because no one believed it. There's a lot of examples in Melbourne. Coburg, for example, also quadrupled in 10 years' time, which is about 9 k's from the city west. So there's a lot of, Sydney's the same, Brisbane's the same. There's a lot of suburbs that have quadrupled in 10 years' time. Some haven't, some's tripled, some doubled. So tomorrow I'm going to teach you property selection criteria, meaning that if you have all these things, if a suburb has all these criteria, its likelihood of doing that is better than the suburb that doesn't have that criteria. But at the end of the day, all you can do is hope. So going back to the loans, is it going to happen? Is the bubble going to burst in Australia? Personally, in my opinion, and being an investor since I was 18, I don't think it's going to happen. I just can't see it happening. I think suburbs are going to get more and more expensive. If you think they're expensive now, wait for another 10 years. There's more and more pressure because they're not building any more land close to the city. And that's the key. So there's areas now in Melbourne where they're astronomically expensive, and yet people are still buying them, rolling over equity from the previous sale. So, based on DSR ratios, people automatically say, well, Konrad, if it's 80% of the rental is so important, shouldn't I go for cash flow positive properties? Right? Because cash flow positive properties give you a lot of rental income. Let me just show you the difference between buying a negatively geared property and a cash flow positive property. What I've done here is a very simple example. And I've used an example of a 1-bedroom apartment in St Kilda, purchased in about 2003. You could have bought one for about $300,000. And buying a cash flow positive property in an outer area, in 2003 you could have gone to a town called Bendigo in Melbourne, where you could have picked up cash flow positive properties. In fact, there's a number of people in the industry that created the cash flow positive seminars around the early 2000s, and they wrote a lot of books about it. Okay, those towns, by the way, today are not cash flow positive anymore. You have to go further out. So places like Bendigo, Ballarat, they're no more cash flow positive. They're actually negatively geared. But I want to show you a very, very simple example here. Normally, if you buy a negatively geared property, which is a property that's very close to the city, that has an inverse relationship between capital growth and the rental yield, which I'll explain in a second. In year one, That property's got a 10% capital growth, so that means in year one it's worth 330,000. If it's got a 4% rental yield, they're usually about 3.5 to 4% rental yields, and the rental yields fluctuate. 4% on that is 13,200. Okay? Now, if you buy an out area property, the capital growth tends to be lower, so you're sacrificing capital growth, but you're getting a higher rental yield of about 8 to 10%. So in year one, you're getting a 4% capital growth on 300, which is 312, but your rental yield is 10% on 300, which is, 10% on that amount, which is 31,200. So people think, well, you know what? So that means I can build my property portfolio a lot quicker because I'm focusing on 10% versus 4%. Not so. Because in year 20, your negatively geared property is 2,018,250, and then you take the 4% off the capital growth value, which gives you $80,730 per year. Where your cash flow positive property, your capital growth is lower, so it's 657,337, and then you take 10% off that amount. So let me just explain this in a different way, because this is a very important point. Let's say you've got a hypothetical property which is worth $250,000, and you're getting a rental yield of $25,000 per year. What's your rental yield as a percentage? What happens when your property goes up to 500? Because remember, rental yields, usually people take 12-month leases, right? So there's a delay between rental yields, or the amount of rent that you pay per week versus capital growth. If your property goes to 500 but your rental's still 25, what happens to your rental yield as a percentage? What happens if your property goes to $1 million? 2.5. So what's the relationship between capital growth and rental yield? It's an inverse one. Now people say, well, where can this happen? What happened in Williamstown? It's $1 million nearly, and the average rental is about 3.1%, 3.2%. So what you want to do when you're looking at properties is not the percentage that you're interested. It's not the 10% to 3%. It's the percentage and the capital growth. Because if we go back to the slide, 4% on 2 million is a lot higher than 10% on 657,000, isn't it? Now, the question is this: which property should you be targeting? And I can't give you the answer for that. I'm just going to give you a couple of explanations and you can make up your own mind. When you're borrowing money, you go through different stages. The first stage is a full doc borrower, where your financials, your income, plays a part. And the assessment is based on 30% of your income. You can still borrow up to 97% today, but generally speaking, it's about 90%. So you need a 10% deposit or a 3% deposit. 97 through Bankwest. Eventually, whatever your income is, whether it's 30, 50, 100, you become a low doc borrower. How much deposit do you need as a low doc borrower? 20% plus 5% closing costs. So on a $500,000 property, you need $125,000, don't you? So if we go back to the slide, if I had to ask you this question, where could I take out more $125,000 chunks? From the equity of this property or the equity of this property? The first one. So what's going to enable you to buy more property over a longer period of time, more consistently? This property or that property? The first one. But that's negatively geared. But see, negative gearing is just a word. It depends on when you actually buy the property. Because Melbourne went through different stages. I'm going to explain to you how that works. But this is a very important distinction because remember, as you're accumulating your properties, your income becomes irrelevant as a full doc borrower. It doesn't matter if it's one property or three properties. Eventually, you're going to be putting in 20% deposits. So the reason why people stop buying properties is because they can't come up with a 20% deposit and closing costs, which you're going to have to do. So what happens with property is this. If we're looking at timeline and the amount of property that you can secure, with cash flow positive property, you can secure a lot of property very quickly. And what I mean very quickly, I'm talking about maybe 5 to 10 properties within the first 12 months. You're putting in small deposits, you're getting a lot of rental up front. So your DSR ratios are very strong. But eventually, you max out anyway. And then, because they don't grow as consistently as inner city properties, you plateau because you don't have, this is where you need a 20% deposit. If you target properties that are inner city suburbs, blue chip suburbs, you start off a lot slower, but eventually what happens is you can secure 3, 4, 5, 6 per year because you can put in 20% deposits and capitalize the interest because you have enough equity. Now, I'm going to talk about capitalizing interest in a second. Because you've got enough equity to draw down from your properties. So, this is instant gratification, this is long term. Can you do both at the same time? Absolutely. Choice is yours. You might do one negatively geared property, 2 cash flow positive properties to counterbalance them. What I do is I just do this one here. That's all I do. And there's different reasons for that. I'll go into them tomorrow. But a lot of it has to do with the type of tenants that I attract. Because let me ask you this. If you've got a property 130 k's from the city that's cash flow positive, and you've got a property which is 6 k's from the city where they're paying $700 per week rental, which properties, and I'm not discriminating here, where do you think you're going to have less headaches? Professional couple driving a Beamer and Audi, $700 a week, or $180 a week, 130 k's from the city? Not saying that those people are not responsible. I'm saying if you had to generalise. Yeah, so, and this is the only reason, it's just turnkey, and I'll talk about that tomorrow, because that's very important. You don't want to have headaches with properties. So, cash flow positive versus cash flow negative property, very important in terms of understanding DSR ratios and how you can get equity out of these properties. And this is just based on 10% capital growth and 4% capital growth. So there's 3 types of investors. Number 1, you're a full doc investor. Your income's important, your equity, not so. You need 5-10%. Eventually, if you keep borrowing, you become a low doc or a no doc investor. There's no income. Your income's not that important in terms of your PYG income, but what's important now, your rental and your equity is important. Number 3 is where you become a sophisticated investor, where you don't need equity, you don't need serviceability, you pretty much don't need anything. Let me show you a deal I did in Melbourne, which is level 3. Now, these deals are very hard to get. So I'm going to show you a property that I purchased with no money and actually took money out on settlement. Now, any people from Melbourne here? No, just a few. So if you draw Melbourne, kind of looks, excuse my drawing. There's the city, there's the bay. Now there's a highway here called the Eastlink. There's Frankston here. The Eastlink is a massive $1 billion project in Melbourne that connected the eastern suburbs to the city. So when this highway was completed, the suburbs that were 25 k's outside of the city on the eastern side, which is the greenest part of Melbourne, the amount of time it will take you to go to the city, which is where majority of people live, would be cut down from an hour and a half to about 35 to 40 minutes. Do you think that's an important factor? Yes. Now, I'll show you all the websites tomorrow, but if you go to infrastructure.gov.au or transport.gov.au, it gives you all the highways, everything that's being built, and I'll show you tomorrow how to access that information. Is it important to buy these properties? So I knew that there's a cluster of suburbs here, just here, which is about 4 or 5 suburbs, and I knew that these suburbs, something was going to happen to them because that's a massive difference in terms of travelling time. So we're talking about Ringwood, Mitcham, Nunawading, Vermont South. Okay? And I thought, shit, this is going to be really good. Now, this link, hypothetically, was going to link up in March 2008. When do you buy the property? Do you buy it after it's connected and everyone knows about it? Or do you try to get in a year before, where it's not in the media yet, no one knows about it? A year before. The other criteria I had was because I wasn't really interested in depreciation on the building, I was purely buying the block to subdivide and put 4 townhouses on it. So my criteria was this. I wanted a block which was 1,200 square metres. I don't care what the property looks like. I want a 12-month settlement plus 1 day. I'll cover that tomorrow why. I want to secure it with a bank guarantee or a deposit bond for 10%. And I want to have a reference of at least one other block in the same street already having been subdivided with 4 townhouses on it. That's my criteria. Then what I did was go to all the agents in the area and say, look, And by the way, when you go to a real estate agent, tomorrow Nigel will be talking to you about how to deal with agents. Agents work on a small retainer and they work for commission. So if you go in and say, hi, I'm Konrad Bobilak, I'm pre-approved for $800,000. This is exactly what I'm looking for. If you find me this property, I'll make a decision in same day. And I've got my pre-approval in place and I'll put a deposit down immediately. Or if you come in and say, look, I'm looking for, I don't know, do you have anything? Maybe something here, maybe townhouse, maybe apartments, we'll look at that, but it depends. The more specific you are and the more, because remember, agents actually will ask you, what's your limit or what are you looking for? But what they're really trying to ask you is, have you got a pre-approval? If you say, I'm pre-approved, ready to go now, you show me this property, I'll make a decision the same day, I want to be the first person they contact. So out of all the agents I went to, there's 2 of them that actually rang me back, out of the many agents that I went to. And by the way, when you go to an agency, you also want to find out who has the most listings per month. You want to deal with the best agents in the agency because they're the ones that are the top performers. They're the ones who will call you. 2 properties came back. One of them was good. It fit the criteria, but the only problem was the slope on the property was too great. I knew there's going to be problems with getting 4 townhouses on it. Second property came in, 1,330 square metre block, 12-month settlement. This person was actually moving out further into Mornington Peninsula. This was a double-storey house, and this was a lady that was retiring, and she was doing sea change, and she wanted to move out and lock in the prices today because the property market was going to crash. I secured the property with a bank guarantee from National Bank, and it cost me nothing to secure the bank guarantee because of my lending. So I got it for free. That property was picked up for $550. So let's have a look at the deal on the money. Now, 12 months later, the settlement was in January, but everyone knew that the suburbs actually went nuts from January, February, March, when the whole thing was connecting. Everyone was rushing into those areas. And this particular suburb was the best out of all the 3 suburbs because Vermont, out of all the 3 areas, is the most prestigious out of Ringwood, Mitcham, Narrawanding and all the surrounding areas. That's where you've got to do research. We'll talk about that tomorrow. The property valuation came in at $750. Now, usually, when you ask a broker about whether you can borrow against the valuation or the contract price, the rule is the banks will give you against the lower of the 2. Would you agree with that? But that's only the banks that are on their list of aggregated lenders. Because remember, most brokers, their whole world is based around the 30 lenders they deal with. I'll show you the website tomorrow, which is canstar.com.au, that lists over 200 lenders. They're not even listed with any brokers. These are small co-ops or credit unions that don't deal with any brokers and they have their own internal credit policies. And there was 2 lenders in Melbourne that will lend you against the valuation even though it was higher than the contract price, as long as it was their own valuer. One of those companies is called Wide Bay, for example. The other one was Australian Housing Loans Group. Okay, so they don't do the traditional thing. They work outside the square. So what's 80% of 750? 600,000. The closing costs were 32,125. At settlement, they actually deposited just above $17,000 into my trading account. How much have I used out of pocket? Nothing, because the bank guarantee was free, because you can get free bank guarantees if you have enough lending with a lender. So that's a level 3. It's basically knowing how the system works and how to structure it. The most important thing in this was the ability to control the valuation process, which I'm going to teach you tomorrow. Because I already knew what this property will be worth based on comparable sales. And that's what I did with the valuer. I actually showed him comparable sales and pretty much predetermined what the property would be valued at. Now, did I knew 100% was going to come in at 750? No, I didn't know. It could have come in lower. I had the funds to complete the transaction. So when you're doing these kind of deals with no money down, you've got to have a plan B. Either you can service it and settle it regardless of the valuation, or as a minimum have joint venture partners that can go in with you as co-guarantors and settle the property, and then you can refinance them out. Never do these deals where if it doesn't come in, you're stuffed and you can't settle, because that's when you lose your deposits, that's when you become credit impaired. So just go back to the slide. There's 3 levels of investing, level 1, 2 and 3. Turn to the person next to you just for 30 seconds, explain the transition from level 1, 2 or 3, and we move on. Okay, take the person next to you. Now I just want to cover a couple of things just in the previous slide. When we're talking about cash flow positive versus cash flow negative property, it's not so much the property that matters, it's actually the money that you are getting out of these property transactions. Because remember, investing is all about creating financial freedom. Would you agree with that? It's about replacing your income, number one, and then going further than that. It's not about how many properties you have, whether you've got 10, 15. It's about getting to your goals with the least amount of effort. Now, one of my friends who works for a developer called Quantum 8 Group, he actually has been buying cash flow positive properties for a long time, and he got up to about 56 cash flow positive properties in Melbourne. And he's actually, he's sold them since. He only kept about, I think, 12 or 15 at the end with the largest land component. And this is the reason why he sold them, and I'm about to show you. If you buy a property today, if you can find a cash flow positive property, and they're out there, and there's a difference, by the way, between cash flow positive just by rental and then manufacturing cash flow positive, okay? Meaning adding value to the property through subdivision, strata tiling, or adding an extension which makes it cash flow positive. But if you're just looking for straight out where the rental is higher than the mortgage, the most amount of money that you can realistically make per week would be around $50 per week, okay? Now let's say your goal, for example, now let me just give you 2 examples. Let's say you buy a townhouse around the major capital city for $600,000. 3-bedroom townhouse, close to the city, close to everything. Fits all the criteria. And let's say the moment you can get $100,000 out of that townhouse, which could be 2 or 3 years, okay? You stick that $100,000 into covered calls, which we're going to teach you today anyway, okay? Covered calls give you a return of about 3 to 5% per month with very little risk. $100,000 at 3 to 5% a month, how much is that per month? That's about $3,000 to $5,000. You've got one property, you've got a tenant paying you around, say, $550 per week. Brand new townhouse, 6.5 year guarantee on the building, within 10K radius. 3 to 5,000 average income. How many cash flow positive properties would you need to have to give you $5,000 per month? Let's say you're getting $50 a week, so that's $200 per month. How many would you need? For $5,000. 5 times 5, 25. Let me ask you this. If you're after financial independence, that's passive, because that's the key. Because I don't want to replace one job with another job. Would you agree? What's the point of that? If you're looking for independence that's passive, would you have more potential headaches with 25 outer area properties or one property 7 k's from the city and just learn another strategy, which is covered calls? So to me, it's not about how much properties you have, it's how much debt you've secured or how much money you control, and then where you put that money and then what you're getting out of it. And that was the thing. For me, it was at the moment I could get 20 grand a month, I'm out of the work industry. It wasn't 100,000. It was, honey, if we can get 20 grand a month on a consistent basis, which for us was 3 months in a row, I'm out. I've quit my job. And that wouldn't affect my lifestyle. Anything more than that, it's cool, but for us, it was 20 grand, and then that's it. So the first thing, this is what we're going to do tomorrow, is you got to get to a dollar figure. It's got to be 15 grand a month or 10 grand, whatever it is, and then you've got to work backwards and translate it back into property acquisition. But the other thing you don't want to do is you don't want to have 50 properties with people calling you all hours, your property manager calling you, that you've got anything over $1,000, you get a phone call, hot water system's broken, the fence falling over, this, that, the other, the tenants have not paid again. I mean, is that financial independence? Not saying it's going to happen, but I'm saying it's the probability of that happening is much higher than having one property 7 or 9 k's from the city. So this is what I've done myself, and this is all I do. I don't get any phone calls, I don't get any headaches, and it's all passive, it's turnkey. And that's what this 2 days is about. It's about teaching you step by step on how to set it up properly. So you set it once, it's turnkey, and you can leave your job because your job is irrelevant anyway. You're relying on serviceability based on your rental, your income's irrelevant. And then you have the option of doing anything you want after that. So that's what we're going to teach you today. Now, I'm running over time a little bit. The next speaker that we have coming up is, I think it's 21st Century Insurance, is that correct? And after that, we've got 21st Century Accounting. And then after that, we've got a share speaker coming up, which is going to tie in and going to show you how to do this based on property acquisition. Tomorrow, I'm going to finish off talking about finance. I've got about half an hour to go. So I've got serviceability. I'm going to show you how to build and structure a large property portfolio. I'm going to get into product-specific information tomorrow. So I'm going to talk about CBA, NAB, ANZ, St. George, Bankwest, which products you should be using and why. So you're going to get enough information that you don't even need to use our broking service. You can just on Monday go to St. George or ING and get the money manager. It's that simple. So you'll know exactly which product to ask for, and I'm going to show you why you should be asking for those products. It's going to be micro level information because that's what you guys want, right? I've been to a lot of seminars where people talk about the big picture stuff. You go out there on Monday, try to talk to mortgage brokers, they don't know what you're talking about. And they give you their own loans that they've been doing for the last 3 years. So I'm going to give you the actual loans, the actual structures, and how to do it. Most of tomorrow is myself. We've got one other speaker. We've got Nigel in the morning, but we've also got a quantity surveyor coming in for about half an hour talking about depreciation. And by the time we finish tomorrow night, I'm going to cover specific due diligence criteria where you can be going out on Monday and knowing exactly which properties to target in Brisbane, whether you're doing Brisbane, Sunshine Coast, Gold Coast, and why. You should be targeting those properties.